So, good morning, everyone, once again. Today, we are continuing from where we stopped last week. Last week, we started a topic known as practice management, where we dive into the world of practice of audit and assurance services, as in what is obtainable within the audit firm. We're able to look at quality control. We start with quality control. We look at the benefits of quality control. We look at consequences of not putting in place a good quality control system within the audit firm. And went on to look at the two types of quality control procedures that exist within the audit firm. We look at each individual audit engagement, where we emphasize that the engagement partner is solely responsible for each individual engagement within his purview. So we'll be the one that will be responsible for ensuring there is good quality control within that individual audit engagement. We said also that in terms of maintaining ethical requirements, in terms of selecting the audit engagement team, in terms of engagement performance, in terms of leadership, is the one that is responsible for all of that. We went on further to look at the second aspect of quality control procedures that exist within the audit firm, where we said that the managing partner is solely responsible in that regard. And then we said that for within the audit firm, there are 7 elements that must be in place for you to know there is good quality control system within the audit firm. And last week we look at each of them. There are 7 of them. We look at human resource. We're going to look at ethical requirements, right? We're going to look at acceptance and continuance of each and specific engagement, right? We're going to look at leadership. We're going to look at monitoring, right? We're going to look at engagement performance, and we're going to look at documentation, right? The 7 of them were discussed extensively last week, and we're able to look at the types of review. We look at that and we practice one question that centers around the area that we discuss. So today we are still looking at the audit firm. We are looking at how they go about obtaining and charging for their professional work. And I need to say also that audit firms, right? They are not NGOs. I need to clarify that. They are out to make profit. They share profit at the end of the year. So in the real sense of what that implies is that they are in business. And whoever is in business, we always look for avenue to create awareness for his business so as to increase the patronage, which extensively will result in what? Increase in revenue, right? So that is what they do. So because they are in business, there's need for them to advertise their services. And in the course of that, there are laid down rules established for audit firms, okay, in terms of trying to create awareness for the service they can render to their client or prospective client, so to say. Okay, so let's look at some of those do's and don'ts of marketing or advertising for the audit firms. First one, anytime they are making adverts, right, they must not bring into disrepute the professional body, the firm and the professional body and the professional body and the profession as a whole. What that implies is that at any time you are trying to make publicity, you must always put at the back of your mind that you are representing the institute. Okay, you are also representing your firm and you're also representing the accounting profession. So anything that is going to bring about discredit, anything that is going to bring about hula baloo, anything that is going to bring about issues that will create unnecessary attention, okay, negative attention to your brand, you should desist from it. That is what it means. The number two, as an audit firm, you should not make exaggerated claim of services you offer and the qualifications process and experience that you have gained. Okay? What that implies is that at all times you need to be what? Honest and truthful, and you should not mislead your clients. Whoever wants to patronize you will patronize you. Okay? Because there's a niche for every audit firm. okay, out there. There are people that need your service one way or the other. Everybody cannot patronize the big four, right? So for every audit firm that exists in the country, there is somebody out there that is out to need your service one way or the other. So you don't need to sugarcoat or to put some facade, okay, that is not warranted, all in the name of what trying to make business. So that's what it means. The number three, you should not discredit the services provided by other audit firms or make disparaging references to unsubstantiated comparison to the work of another chartered accountant. What that implies is that every time you are publicizing your services, focus on your act, focus on your work. Do not make disparaging claims. Disparaging claim means, for instance, you are saying that you are boasting that you are the best audit firm in Nigeria. There's no best in terms of audit firm. What you can see when you say you are the best, what that implies is that you are saying that every other chartered accountant, every other audit firm around, they are second fiddle. They are not as important or they are not as relevant as you are. And you know that that alone can dampen the morale of other chartered accountants who are out to make honest living. So at most times, when you are trying to make adverts, you are trying to create adverts, always ensure that your advert reads something like this. You are one of the leading audit firms. You are one of the best audit firms. You're one of the foremost audit firm. Never you say you are the best audit firm. Anytime you are trying to make your advert, it is not acceptable within the confines of the audit and assurance profession. Okay. Next, also, you must not break, aside from all of this, the Advertising Practitioner Council of Nigeria, APCON, right? They have their own code of ethics, which we are supposed to what? Comply with. On no occasion should you breach any of their laid down rules. Okay. So in as much as they are trying to comply with ICAN laid down rules, it is importantly necessary that you also comply and adhere to the laid down rules of the Advertising Professional Council of Nigeria because they are the ones that are giving the mandate, okay, that relates to anything that has to do with what publicity. Also, you must not offer discounts to your clients. What that implies is this, especially for your new clients. You know, as an auditor, you render diverse range of services to your clients. So, in a way to try to woo them or to make it attractive to them, never you say you render service for three, but they are going to pay for two, or they are going to pay for two, where they are going to give some little change on the third service they are rendering. On no occasion should you do that. The essence is that ICAN, the institute, pride itself as one of as a leading and a foremost professional body in the country. Okay, you can see that ICAN has been in existence since 1965. As I speak with you now, we are now up to 100,000 chartered accountants dead or alive, okay, in Nigeria. Even those that have traveled out of the country for greener pastures, we are not more than 100,000. And the population of Nigeria is how much? Is estimated to be around 220 million. So what that implies is that because of the way and manner the institute has carved or has portrayed itself, they are taken with all seriousness. Okay. So at any point in time, you should ensure that when you do not water down the service you are rendering to any of your clients, because all the service you are rendering to your clients, whether you like it or not, they are premium services and they should not be given very cheaply. Okay. Then next, you must not make comparison with the fees of another service provider. What that means is that do not say that, do not compare your audit fee in a way to make market to say that, oh, our charges are fair compared to our competitors, the big four. Talk about only your business. Do not bring in any other audit firm. Just concentrate on your own business, market your business. Okay? So that is those are the do's and don'ts of advertising and publicity that each audit firm needs to comply with. Okay. Now, I also need to look at, does anybody have any question before we proceed? Any question, any comment, any observation? If there are no comments, if there are no observation, we proceed, right? Now, we also need to tell us that the institute has nowhere in their code of conduct specify how much child accountants should charge or how much child accountants should be paid. Those that are in private practice, okay? Those that are in public practice are those that are working in audit firm. There's nowhere that they say that they have a fixed charge for the services rendered. That is why you see that the ranges of salaries for child accountants that are gainfully employed in the private sector, some of them they earn as low as 100,000, 150,000, and the likes, and some earn as much as over 1 million. So there's no caveat, there is no structure in that way. However, the institute has given out a guideline for the audit firm on how to go about charging for the services they render to their client. And here is how they have talked about it. So the code, the ICAN code of conduct talks about these are areas when you want to determine the audit fee. One, you look at the seniority and professional expertise of the persons necessarily engaged in the work. What that implies is that you cannot compare the wealth of experience of someone that just qualified and the one that has been in practice for over 20 or 30 years. You can't compare their weight of experience. And it is based on that they also determine their audit fee. Okay. Number two, the time expended by each. Now, the time you are allocated for each of the tasks that is embedded in an audit engagement, we also determine the fee that will be charged. I told us that if you work in audit firm, they pay you per hour. Your pay is calculated per hour. Okay. So the more hours you spend, the more it's going to replicate in your total emolument at the end of the month, right? So if you put in less hours, if you are engaged less hours for less hours, that means that at the end of the day, you are going to earn less. So that is another determinant of the audit fee. Then another determinant of the audit fee is the degree of risk and responsibility which the work entails. Now, sometimes you have clients that are in a dilemma. We have clients that are in precarious situations where you will be like the saving grace for them. Now, in trying to save the face or the faces of your client from these precarious situations, sometimes you put your brand on the line. Your brand is at stake. How do you explain when you have a client that has issues with tax authorities and they have the last hope for them to not to be sealed up as an organization is for them to get it right for the last time. And they have run to you, knowing fully well of your reputation. They now say that please, we need your help. Okay, and you know that you are putting your own reputation that you have earned over the years on the line for this particular client. So it's a 50-50 chance. So sometimes that could be a determinant of how much you are going to charge the client when you are rendering this kind of services. Another thing that also determine the fees that you charge for your services is the priority and importance of the work, okay, to the client. So if the client place, I mean, place much emphasis on the priority or that particular engagement, then that could be a, a determinant of the audit fee. So for instance, you normally engagement might take up to like 2 months or 3 months thereabout. But your client is saying that I want this thing like yesterday. That means he wants you to deploy resources from everywhere, all over, to ensure that you deliver the result to them within the specified period, let's say 2 weeks or 1 month. So in the course of you pulling resources together, it will also lead to increase in your what in the audit fee that you're going to charge them. So these are the determinants of audit fee in an audit firm. So whenever you hear of audit fee, there could be questions around it. These are the conditions that you use to assess or evaluate how much you are going to charge your clients. Okay. I hope we are cleared. Okay. Is there any question, any comment, any observation? Comment, question, observation? We are good. All right. I want to believe that silence is constitutes acceptance here in this instance. Okay. But in law, the silence does not constitute acceptance. So your silence here, does it constitute that you are with me? There are no questions for now. All right. Thank you. So let's go on. We go on to the next area of the chapter, which is called tendering. 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 What is tendering? Now, audit firms, right? They have a way of uh, getting some of their big clients. Okay, one of the ways of getting some of their big clients is through the use of what? Tendering. Okay, what do I mean by big clients? So if an firm wants to engage multinationals, right? There is a particular manner in which they normally get those clients, and that process is what we call tendering. So tendering is a commercial process widely used by companies, especially larger companies, when they wish to change their auditors. So what that implies is that when a big company like Dangote, like BUA, like Mobi, like any of those banks wants to change their external auditors, they can't just change the external auditor and do it secretly. They have to make it what? Open. They have to put it in the national dailies that they invite tender from audit firms that they would like to change or replace their existing auditors. That is the process. So in that process, in that manner, then the audit firm we have to now look within. Is this something they are caught out for? Because for you to engage in what we call tendering, it takes a lot of time and other resources. Okay. So you cannot afford to waste your resources. And at the end of the day, you don't get the offer or you don't get the engagement. So at all times, before you embark on deploying resources towards tendering for such engagement, you have to do a self-evaluation of yourself. You know, there's a saying by Socrates that know thyself. So it is only you that can know yourself. Only you that can talk about yourself. No other person knows you better than you do. Okay? You know yourself, you know capacity, you know your capacity, you know yourself, you know what you can do. So in that vein, so you need to do what we call an internal evaluation, which we call initial consideration. So if you're able to answer honestly these questions by yourself, then that will explain the fact that you can proceed to make your tender for that particular prospective client. So these are the questions you need to ask yourself before you proceed to what tender. And like I said, these are the preliminary consideration, initial things you need to do. You know, audit is planned. It's not something that you just do haphazardly. It is a planned process. It's a procedure. You always talk about audit procedure. So this is a procedure you need to do first so that you don't go and waste your time and resources at the end of the day, it will result in what? Vanity. So these are the questions you need to ask yourself as an audit firm. Who is going to determine this one? It's usually the managing partner or managing partners. They will sit together and answer these questions. Frankly, they'll be frank with themselves. And these are the questions. Number one, does the firm have the expertise to carry out the work, the audit? So there are specific engagements that requires specialized competencies. Okay, so you need to ask yourself for this kind of engagement, do we have the competence to do it? If you don't have it, you cannot fake it. You cannot say you have it. You cannot claim it by faith that you are having it in Jesus' name. No, you are having it, inshallah. No, you have to be sure that you have this knowledge. If you don't have the expertise, you cannot fake. That means you don't need to waste your time in that area. For instance, your client says that they want all the external auditors that have vast knowledge in what forensic accounting, or they want auditors, auditors that have vast knowledge in what in data infrastructure or data integrity. If you don't have the knowledge, there's nothing you can do about it. Okay, you cannot give what you don't have. So you need to ask yourself, Number two, you need to ask us another question. Does the firm have or could it have sufficient staff available at the appropriate time? Knowing fully well that audit firms, they run two periods, which we call seasonality. Okay, seasonality means that there is peak period and there is off-peak period. In fact, every organization has peak period and off-peak period. That is, peak period means times where they are fully engaged, they don't even have time for themselves. And there are periods in audit firms that they are so relaxed that they don't have much to do. Like now, for instance, all the audit firms now, they are busy. In fact, most of them, they are in their peak period now. Why? Because most of their clients are the banks, financial institutions, okay? And it's expected that their audited financial statement must be ready on or before 31st March 2025. So all hands are on deck now. Some of the audit firms staff, they are sleeping over in their client offices now to ensure that they get this audit report out and file it with the CBN and other regulators so that their clients will not suffer penalties and sanctions from CBN. That's what we are saying. So if you know if you know that this particular type of engagement falls within the peak period, you need to evaluate it. Is it something you can make available the necessary staff? If not, you might need to debunk going proceeding on that engagement. Number three, you need to ask yourself, are there any ethical reasons why the firm could not act? For instance, maybe you didn't know before that the owner of that business or one of the directors of that business, they are they have what? They are related by blood. Okay? They are related by blood. That could be an hindrance because if you look at chapter 3, rule of professional conduct takes that you have to be independent and you have to be seen to be what? Independent. That means you have to have independence of mind and you have to have what? Independence in what? In appearance. So where you cannot actualize this, then there's no need for you to proceed because anyway, if you proceed, what that implies is that there will be some level of what undue significant influence over the engagement, and you'll not be able to be you won't be objective while carrying out the engagement. So those are some of the things you need to know. Another question you need to ask yourself is that are there problems of which the firm is aware with the current audit or auditors, specifically in relation to a tender, the firm should also ask itself. So, like I said, these days, or the practice is that if you want to take over from another audit firm, you can't do it secretly. You have to get the buy-in and the support of the existing audit firm. If the existing firm does not support you coming in, you try to get that engagement by fire by force. At the end of the day, that engagement could boomerang because the existing auditor will do what? We escalate the matter to the institute, and there will be serious consequences for that. Hence the reason why for every new engagement, there must be what we call professional inquiry. That is, the existing auditor and the new auditor must agree to work together. They must agree, they must share information. Where they don't share information, even the new auditor coming on board, we find it difficult to embark on that particular engagement because some of the vital information that is required, he or she might not have it. So there's a need for a liaison between the existing auditor and the outgoing and the new auditor coming on board. So where you were able to correlate with your outgoing auditor, there are certain information is going to share with you. And some of this information, they are shared so that it will inform your decision making. When they share this information with you, it's for you to do what? To inform your what? Decision making. So when they share those information, for instance, if the client says that, oh, this client, they've not paid them for service they have rendered for them 2 years ago. They still want them to continue. That's why they are discontinuing their services. So when you hear this as a new audit firm, you shouldn't say, oh, that one is your own case now. Me, I'll continue. They'll pay my money. You can't work like that. You have to work together with that or the existing audit firm that they settle that outstanding before you come on board. If you don't settle those outstanding before you come on board, and you eventually get the engagement, that existing outgoing audit firm will petition the institute and that audit firm may probably lose that engagement with the new client. That is the way it works. So that's how you say that there's questions, there's certain information that will be revealed to you by the existing audit firm. So if you are comfortable with it, you can continue. If you are not comfortable with it, you can decide right there that you don't want to continue with the process of tendering. The other question you need to ask yourself is that why has it been asked? Why have you been asked? Why is your firm been asked to want to tender? So you need to look at what are the significance of you tender. What will this tender bring to your firm as a whole? Is it going to increase your revenue? Is it going to increase your brand? What is it going to do for you? Okay. So these are some of the questions you need to ask yourself. Another question you need to ask yourself is that could it or should it offer to do the audit for a lower fee than other firms are likely to quote? So there is what we look at it as in the course of this class. In a way, for you to get this engagement, there are tricks that you can play as auditors, as audit firm, which are allowable. Okay. And the trick is that if you have a range of how much the audit fee could be, you can decide to beat your other audit firms to that. That is by lowering your own audit fee. So that by the time they are considering selecting the best audit firms, you will have a basis for them to prefer you to your other audit firms. Okay. The other question you need to ask yourself is this: are there any questions why this audit is particularly attractive to the firm? So, for instance, let's say the client has been their client base is purely small, medium enterprise SMEs, but this particular one is targeting uh, real estate or an oil and gas company. And you know that the oil and gas company and the real estate, the audit fee will be higher than the small, medium enterprises. So that means that they want to break the jinx of collecting audit fee that range from 1 million naira to like maybe 10 or 20 million naira. So that will further increase their what? Their revenue base, okay, as an audit firm. So if you're able to answer this question honestly and your answers are affirmative, that is, your answers are positive, then that will make it possible for you to do what? To proceed to the next stage, which is for you to go on with your what? With the engagement. Okay? That will enable you to go on with your what? With the engagement. Now, before you go on with the engagement, right? Another thing that is very important for you to do is to conduct what we call a preliminary audit risk assessment. A preliminary audit risk assessment. What does this imply? This is an assessment that will give you insight into how the client business operates. Because it is important to state that you cannot audit what you don't have or what you don't know. You can't audit what you don't know. So what that means is that the client will afford you the opportunity, okay, to ask some questions. In fact, you might even visit some of those client business premises to see for yourself. Is this something that you are cut out to do? Okay. So the essence of all of this is to enable you to effectively prepare your tendering document. Okay. It will essentially assist you to prepare your what? Your tendering document, as well as your audit plan, if eventually you are successful as the preferred audit firm. Okay. So you need to carry out a preliminary audit assessment, okay, which will give you insight into your client business and other things that might not be open to you at a glance, okay? So after you have done the preliminary audit assessment, the next thing for you to do is to continue with your work, with your tendering process. So what do you do? At that point in time, you start to prepare your tendering document. So you have information that relates to your audit firm as a whole, okay? Who are the key partners? There's what we call an audit brochure, okay? Audit brochure is a document that explains the key partners of the business, who are the key personnel, how long have they been in existence, who are their clients, what services do they render, It just gives snippet as to what is obtainable within the audit firm, so that at a glance, a client can make informed decision on whether to continue, whether to proceed or not to proceed with such audit firms. Okay, so you'll be able to do that. Then also, you in that your document also, you're able to establish the precise scope of work to be performed and the specific requirements of the prospective client. So what that implies is that you have to be able to, the essence of that preliminary risk assessment is to afford you information, okay, that we assist you to establish the scope or area of audit work. All right. Then in that document also, you are going to, that attending document, you're also going to include your audit fee and how you arrive at the audit fee. Okay. You include your what, your audit fee and how you arrive at the audit fee. They would like to know. Okay. Then when all of this is done, I talked about the what's it called? The audit brochure, okay, where I talked about the firm, that contains information about the client, about the audit firm. These are the documents, some of the information that we contain in that brochure. So all of these documents will be done what? Will be compiled, right? And submitted within the specified time, because the tender is not going to be open forever. There's a timeline for submission of the tender. So when they're able to submit before the deadline reaches, or before the deadline closes, right? Then it will afford your tendering document to move to the next stage. Okay, the first stage is what? Initial consideration, where you ask yourself questions. The second stage is where you prepare your what? Your tender document that you're going to present or you're going to submit to your client. All right. Also, you should prepare your um tender document in such a way that there will be avenue where you do what? Where you appear in person, physically, to come and defend your tender document. The essence of this is that some people, they are good at what? Words. They can prepare document, but they are public shy, or they don't like, they hate public speaking. So, and those are some of the things that they want to test. So at the end of the day, you must have the back of your mind that you must prepare a document in such a way that there will be a venue for you to come and defend your tender document publicly. All right. Then after all of that has been done, the submission date has ended. The client will now start to what? Scrutinize the tender, the only firm that have submitted or have indicated interest by way of what? Submission of their tender. So while the client is trying to evaluate the tender, they are going to do so in the following order. So the considerations they are going to consider are: number one, the fees. So if you have an audit firm that submitted tender and has the least fee, that could be one of the criteria that will make that audit firm to be what? To be selected or to be successful. Number two, you also want to look at the caliber of services that the audit firm can render. Is it just rendering audit services, or can it do other range of services, so as to enable the client to just engage the audit firm fully for all the services that they render? So they want to see the services, they'll compare the services rendered by each of those audit firms. So the one that has more services than the other, that will also be a criteria for selecting them. The third thing they also need to consider, that is the client now, look at the geographical spread of the audit firm. You want to see, is the audit firm only located in Lagos, or the audit firm is located in all the states of the federation and even all the countries of the world. And that is why most organizations, they always prefer the big four, because there's no country that you get to, you don't have the big four. There's no country in the world that doesn't have what? The big four. So that's what gives the big four edge over other audit firms. So the more geographically spread you are as an audit firm, the better it is for you to secure your engagement as a preferred auditor. Then another thing also need to look at is expertise of the firm and its staff. you look at the crop of personnel that work within the audit firm. Okay, so if you see that there are some people on the audit firm, on the brochure that has been um on the radar of the media, whether social media or whatsoever, right? That could be a signal to whether to continue with that engagement or not. For instance, remember some weeks back, that last year, right, when one auditor that works one of the big four was beating his wife. If you remember the name of that lawyer, he works in an audit firm. So if somebody has memorized the name of that lawyer that works in an audit firm and informs key personnel in that audit firm, do you understand what I'm saying now? Somebody can spot us. Ah, look at that. You know the guy that beat his wife the last time. So they will not be having so many. And let's say the couple of the people that are on the board of the client business, they are women. They will say that this one we not want this one because that means that this one does not support women. Okay, that's what we mean. The reputation of the firm also another thing they are going to look at how as the audit firm being involved in one scandal or the other. They're going to look at all of that. So at the end of the day, if there's any need, they will ask the client, I mean the audit firm, come and do a physical presentation. Okay? And that physical presentation is just for them to test whether they'll be able to work, be able to cooperate, work harmoniously with the audit firm. That is the management and the audit firm, whether they can work harmoniously together. That is what you want to do at that point in time. Because by the time they ask questions, they want to test your resilience. Okay? Are you somebody that when they ask any question, you get irritated? Are you somebody that when they ask questions, you are composed, you are not bothered, you are just answering question in a very polite manner? You know, some people when they keep asking questions, it gets on their nerve, and before you know it, they start to uh, agitate. Okay, they start to get annoyed from the tone. So from there, they will be able to check the psyche, okay, of the people, the composure, all of those things. They're going to check all of those things just to be sure that to a large extent they have done their diligence when they want to select the audit firm. So those are the processes. Okay. Then that takes us to the next one, which is called lowballing. What is lowballing? I've explained lowballing because of this class today, where I said that it's a practice of tendering in which the audit work at is what is offered at a low fee with the intention. It's an intentional act. Okay, with the intention of what? Winning the audit. Is a practice that is usually used during tendering, where the audit work, the fee, right, is intentionally reduced in order to what? To win the audit. Okay? All audit firms, they do it. Not even the big four, they do it. So what that implies is that let me give an scenario. So you have a client, let's say Mobi, producing unlimited now, right? He put out invitation to tender that needed an external auditor. And the big four, all the big four, they are interested. And another audit firm, that small medium audit firm, also indicated interest and also tendered his proposal. Now, upon the small medium audit firm, we know that the big four, there is a range of audit fee they will not go below. For instance, let's say the big four, they want to charge anything from 100 million and above. And these clients, and this small medium clients say that no, if I charge 100 million, that will not give me that avenue for them to consider me. So I'm going to charge 25 million. So, and then when we look at when they're trying to evaluate the tender, one of the criteria is what? Audit fee. So when they now saw the small medium audit firm, Ade and Co, chartered accountant, saying that the audit fee is what? 25 million naira. They will marvel. They say, And luckily, the audit firm, Ade and Co, was able to overly impress the management of the client, right? So at the end of the day, they gave the engagement to that. small medium money firm, Ade and Co. Now, after Ade and Co has started, they saw the way he was doing his work, they are impressed. So now decide to off because he said that he cannot also render other services. And they wanted to extend the services that he will also render on their behalf. And they said that, will you be interested in handling our tax and advisory services? And he said yes. And they now asked him, how much are you willing to take? That was where he now remember he tried to what get back at what at them. That means that the other time when he deliberately reduced his audit fee is for him to get that engagement. Once he gets the engagement, you're already in, right? You have an edge over others. So he now says that, okay, my audit fee for that tax advisory service is, let's say, 100 million now. You know that they cannot just say, oh, you will get another person. You'll start negotiating with him. At the end of the day, you might settle for, let's say, 70 million or 80 million. Give or take. That money that he lost at the initial point when he collected 25 million naira, he has gained it now. That's what we mean by low balling. So it's a smart move. It's a strategy that audit firm utilizes when they try to win over their other audit firm in the course of the engagement. Okay? Are we good? Any question? Any question? Any comment? Any observation? Nobody's asking question. Are we all
No
good?
comment, sir. No comment.
All right. Thank you. So that is low balling. So I want you to note here is that there has not been anywhere where the practice of low balling has led to low quality auditing work. It has not been established anywhere. And because you charge less audit fee, they're not going to do a jamboree, a kangaroo audit. No, they will still do the work because they know that there are other ways they are going to get back what they initially lost. Okay, that is why. So that is what that implies. Okay. In terms of no question, we move on to the next area, which is agreeing the terms of audit engagement, ISA 210, the objective of the engagement letter. Now, let me explain what this one means. Okay, some of us have read this thing. We have read the ICAN study text over and over again. Sometimes you find it difficult to be able to comprehend what some of the things that we have here. Now, what you need to note here is that one of the reasons why this class is holding is to guide us on how to comprehend some areas of the ICAN study text, right? Some of us have read this thing over and over. If I ask it randomly now, I know people have divergent opinions on this area. But let me just try and explain it so that it will be easier for us. Now, before the letter of engagement is signed, what is letter of engagement? Letter of engagement is the letter that mandates or that confirms that this engagement, these clients and the audit firm, they are what? They have agreed to what? To work together under certain condition or certain conditions. So that means that it's like a contractual agreement between the client and the audit firm. So once they have agreed to work together, right? So they will now sign the letter of engagement or the engagement letter. That is in an audit engagement, they make use of three letters. They have the audit engagement letter, they have the written representation, and they have the letter of weakness. Letter of weakness. These are the three, the one we normally call management letter. You have the written representation, or we call it letter of representation. You have the letter of weakness, which we normally call management letter. And we have the engagement letter or letter of engagement. But the first letter that will be issued by the audit firm is letter of engagement. Okay? So before the letter of engagement is signed off, there are certain things they are going to do at the back end, behind the doors, that will not be known to others. So let me put it into perspective. So remember the likes of Messi. I must explain to us that there's no time you are going to talk about audit where you are not going to see it in everyday activity. There's not no news that you hear on social media or anywhere, any space, media space now, right? That if you look closely, you'll be able to attribute it to audit and assurance. So remember the time when Messi was trying to move to LA, Miami or LA Galaxy, the one in the US, Lionel Messi, and also see Ronaldo. Now let me make emphasis on C Ronaldo because Messi he moves to a what do you call that place? A cosmopolitan area. There's no issues there. I'm going to make a case for C Ronaldo. Now, C Ronaldo moved from Real Madrid to that club in Saudi Arabia. Saudi Arabia is an Islamic country. Okay, Saudi Arabia does not condone living lovers, people that are not legally married, to live together. It is not allowed. Now, when they were yearning for C Ronaldo to come to Saudi Arabia to help to increase the branding of their league, the Saudi league, there are certain conditions that C Ronaldo put forward. One of the condition is this: one, I have a girlfriend or I have a partner. We are not married, and I know that it is not allowed, it's not acceptable in your country. How will I be able to move around and I will not be what? Castigated by the Saudis. That is one. Okay? That is one. That's a major one. That is a major one. The number two, how will I be able to move, okay, from, let's say, from Spain to Saudi Arabia, and all the things I normally do in Spain, I'll still be able to do them in Saudi Arabia. Okay? By going to the beach, by doing all of those things and all of those things and so many other conditions. So before they now announce that he's signing off with that club in Saudi Arabia, these are the backdoor discussions that they had. So if they have not consented to all his demands, then I'm telling you, he would not have moved to Saudi Arabia. And that is why, as he's in Saudi Arabia now, he did not leave his partner behind in Spain. They are living together in Saudi Arabia, even though they are not married. You know what I'm saying now? That's just a perspective to it. So for the auditors too, before they issue letter of engagement for the clients to sign, they must have some discussions at the back door. That is behind the back door, behind the doors, that there will be no media. They're just going to have heart-to-heart talk on what their expectations is or are from the client. Okay. So some of those conditions, some of those issues, some of those concerns are what is contained in this ISA 210 now that we are talking about. So those that you understand. So before the engagement letter is signed, the auditor or the audit firm will ask whether the client agreed to all of these conditions. One, that is, they establish whether the preconditions for an audit are present. What are the preconditions? We'll get there. Two, confirming that there is a common understanding between the auditor and the management, that both of them have agreed to work together. Okay. Three, to establish if the preconditions for an audit are present in ISA 210, which requires what? One, these are the preconditions now. One, that the client will ensure that they comply with the acceptable financial reporting framework, which is IFRS, acceptable financial reporting framework. They are going to prepare financial statements in line with IFRS, acceptable financial reporting framework. Two, that the management has also agreed that they will be responsible for the preparation of the financial statements, not the auditor. That the management will be responsible for what? The preparation of the financial statements. The auditor will just come to do what? To evaluate it. Three, that the management will be responsible for putting in place sound internal control system. Able to do what? Put in place what? Sound internal control system that will ensure that the financial reporting is not what? Is not impacted negatively. There's what we call internal control over financial reporting, ICAN. So if you have a weak internal control, indirectly it's going to affect what? The financial reporting. Hence, there is a need for the auditor and the management to agree that it is the sole responsibility of the management to 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 ensure that the internal control system complies with is strong and is effective. Also, the management also should agree that they will provide the editor with all relevant and requested information and unrestricted access to all personnel. Unrestricted access to all personnel. That means if the auditor wants anything or anybody, they should not hesitate to provide or to present the person or the information to the auditor. Once all of this has been agreed, then the letter of engagement will be presented to the client to sign. But where the client refuses to comply with any of these conditions, then it means that the auditor is under what? A limitation of what? Scope. That is, the management has imposed a limitation of scope on the work of the auditor. That means the auditor will not be able to carry out his assigned responsibility, which is going to impact on the audit opinion is going to issue on the financial statement. Two, where they refuse to these preconditions, it means that financial reporting framework that they have used to prepare financial statement is not acceptable to the auditor. That means the auditor is not accepting the financial statement they are using to prepare to prepare the financial statement. So if management refuses to listen or to comply to these above responsibilities, the auditor has the right to refuse to continue with the engagement. Okay? The only reason why the auditor we continue with the engagement is where the management agreed fully and takes full responsibility for all these preconditions. Okay? Once he accepts all these preconditions, he can proceed to continue with that engagement. That is that. Then the last or the next one is called the letter, content of the engagement letter. Now, the engagement letter, I've explained what engagement letter is. So, what are some of the information that are contained in the engagement letter? One, it contains the scope and objective of the audit. Every engagement has an objective and they also have scope. So, the letter of engagement contains the scope and objective of the audit. Two, it contains the responsibilities of the auditors. What are the things that the auditor is expected to do? Is also contained in the letter of engagement. Three, the responsibilities of the management too is also contained in the letter of what? Engagement. The responsibilities of the management too is also contained in what? The letter of what? Engagement. What the management is supposed to do. What are the management supposed to do? One, they have to ensure that financial statements are prepared in line with the applicable financial regulatory framework. Two, they have to ensure that they have sound internal control system. Three, they have to ensure that they are the ones that prepare the financial statement and not the auditor. Four, they have to give unlimited access to information and persons that are responsible for the creation of the financial statement. Okay, these are some of the responsibilities of management. Then the next content that is also contained in the letter of engagement is identification of the underlying financial reporting framework. Like in Nigeria now, we use IFRS. You have to state it there that the financial statements are prepared in line with IFRS, National Financial Reporting Standard. Okay? Then the last one there is reference to the expected form and content of any report to be issued. So you need to tell them the form in which the report will take. Okay? Are you going to send the report to them via mail? or you're going to send it via, you're going to send the report to them via mail, you're still going to present it in what? In hard copy. Okay? Or are you going to use the social media, WhatsApp, okay, to send the report and you're still going to discuss it? Whatever form you are going to take with the report, right? You have to let them know. And that is always contained in the letter of engagement. So these are some of the information. It is not exhaustive, right? There are much more. But like I say, in ICAN exam, they always ask for the minimum. The minimum is what? 5. Especially when they state that list 5 or explain 5, give them the 5. But where they say what are the contents of the letter of engagement, you might need to write above or beyond these 5. So if you look at your ICAN study text, you have much more there, right? But what I've picked here is the 5 most important, okay, content. So that is just that. So with that, we are done with chapter 5, practice management. Any question, comment, observation before we proceed? Any question, comment, observation? Are we good? Any question, comment, observation?
Okay, please, sir. Could you
Yes,
just
go
take
ahead.
that preconditions of an audit, a little over again?
With conditions of an audit.
Yes, yes. It
Okay,
appeared in some of your bullet points.
okay. Now this is it. Sorry. Now, the preconditions are, that is, what are the things that the auditor is looking out for? What are the expectations of the audit firm from the client? That's what we are saying. So the preconditions from the audit clients, I mean from the auditor, what the auditor expects the clients to provide or to meet are, number one, they must ensure that there's a common understanding between the auditor and the client. That's the first thing. There should be what? A common understanding between the auditor and the client. That is the management. That is one. Two, the preconditions are, after they have agreed, the preconditions are, the auditor should make it known to the management that they are the one responsible for the preparation of the financial statement. They will be responsible for the preparation of the financial statement. Two, they will be responsible for putting in place a sound internal control, okay, over financial reporting. Okay. And also, they will be responsible to provide the editor with all relevant and requested information and unrestricted access to persons. Those are the preconditions, sir. Is there anyone that you have not mentioned? Are you with me, sir? Have I answered your question, sir?
It's fine. It's fine, sir.
All right, sir. Thank you. Any other question? Any other question? Any other question, comment, observation? Do you have any other question, comment, observation? If there are no questions, I think we'll move to the next topic. But before we move to the next topic, I'm trying to see if there are other questions that we might quickly look through. If there is, I think we have looked at a question that relates to this topic last week anyway. So I think we can go to the next, we can move to the next topic, right? So that is that. So just hold on. Since you said there is no question, we can decide to proceed. You know, coming. So you have no questions. We move to the next topic. Coming. I'm coming. This is the next topic we need to talk about. Okay. So I think we can go to the next topic now. Okay. We look at we just finished looking at practice management, right? So let's go to another one. Let's go to chapter 6, which is the audit approach. Let's go there. Since there's no question, uh, audit approach. That's a minute. I mean, can you see my screen? Can you see the new screen?
Yes,
You can see the audit approach, right? Okay.
yes,
Thank
yes.
you.
It's up.
All right. Thank you. Okay. Now, what we look at initially now is a fallout, or let me say, the forerunner to the next topic. That is this topic we are discussing now. The topic we had before, that is practice management, is a forerunner to this one that we are discussing now. That is, you have to talk about the practice management before you go to the audit approach. That's what I'm trying to say. Okay. So that's how the topics are, they are linked. So the audit approach, we now commence or we now take off from where the practice management ends. The audit approach, we take off from where the practice management what ends. So when you talk about audit approach, you're talking about all the strategies the auditor will utilize or will deploy in order to obtain evidence that will be able to support the auditor in the course of what? Expressing an opinion on the financial statement examined. I take it again. When you talk about audit approach, you're talking about all the strategies deployed by the auditor that enables him to obtain information or evidence, audit evidence, right, in the course of an engagement that will enable him to express an opinion about the financial statement examined. That is what the audit approach is all about. Okay, that is what the audit approach is all about. So it's just like when they want to play a match now, right? All the steps taken by the technical advisor or the coach to ensure that they win that match they call it strategy. So it's the same thing you're talking about now. So for every engagement, it's also seen as what? Like a match. So it's an engagement. So the audit firm will also ensure that they put all the necessary measures in place to ensure that at the end of the day, the objective of the audit is what is achieved. Because that is the most important thing. If the objective of the audit is not achieved, then the audit has not been done. Okay? So, in the course of this, right, the auditor should consider his responsibilities as defined in the terms of engagement. We have looked at the terms of engagement, those preconditions, right? We have looked at the terms of engagement as contained in the letter of engagement. Then the auditor needs to familiarize himself with the client business and organization because you cannot audit what you don't know. That's why we talk about the ISA 315 that talks about assessing the risk, okay, in a client business. You must be able to assess your client business. You must be able to know your client business. If you don't know your client business, then that means there is an issue. Then one of the ways you can get information about your client business is to conduct what we call a preliminary audit risk assessment. Okay, when then you carry out a preliminary audit risk assessment, you're able to evaluate the client's internal control system and the accounting system. You'll be able to evaluate what the client's internal control system and the accounting system. That means you'll be able to look at the ERP they are using or the accounting package that they are using and what sort of internal control system exists within the what within the organization. Number next, after you have understood your client business, the next for you to do is to know which strategy will work better for your client because not all strategies work in a client business. So you need to look at the peculiarity of your client business and adopt a strategy you think will work. Okay? So let me give an instance to that. Let me put perspective to that. So you have a client, SME, small medium enterprise, that does not have a computerized environment or computer-based environment. You cannot deploy a sophisticated audit strategy in such an environment. Otherwise, it's going to fail. It's not going to achieve it's not going to achieve the audit objective. That's what we are saying. So let me just give an instance. So you have an audit approach that is called risk-based, business risk or risk-based audit approach, which is mostly used for clients that have put in place a structure or clients that have put in place business that is what well structured and they operate a computer-based environment. And it's mostly for multinational big organizations. So you now want to deploy this in an SME, small medium enterprise, where most of the things they do are done manually. It will not work, it will fail. It will do what? It will fail because that strategy does not match with what, or does not match with what the client does. Do you understand what I'm saying? That's what we are talking about. Then also, the auditor or the audit firm should be able to evaluate the client internal control system because the evaluation of the client internal control system will go a long way, right, in assisting the audit firm to know what strategy will work best in the audit firm. Okay? Then at the end of the day, when that has been done, the client, the auditor will discuss all these weaknesses, okay, with the what? With the client. At the end of the day, when he's done with the engagement, he's going to discuss all these weaknesses with what? With the client. Okay? But before he does that, he also needs to look at those weaknesses. Are there compensating controls? What do I mean compensating control? Yes, you saw a gap somewhere. Let me give an instance. So your client operates a biometrics attendance system. That is when people come in, they clock in using their what? Their fingers, okay, or face recognition, and they come in, right? Now, It's not all the time that we have light in Nigeria. Our light is not constant. Even if you are on band A or you're on bandit, right? It's not all the time that you have light 24/7. So what happens where there is no light and maybe your generator refuses to work or your inverter just stopped working? That means we will not be able to gain access into this business, into their offices, or they'll not be able to exit their offices. So that means that they must have what? Another procedure or another system in place that in case this biometric fails, we have another uh, measure in place. For instance, let's say biometrics fail. That means they will have configured in such a way that once there is no light, the access control is disabled. So people can come in and go out. Then they will now provide what? An attendance register. You know what I'm saying? That's what we mean by what? Compensating control. Do you understand what I'm saying? That's an instance, right? Then also, these controls, the auditor or the audit firm, we need to test them. How will the auditor test those controls? The auditor will conduct two tests. Before now, we call those two tests compliance testing and substantive testing. I need to tell us now that in this 2024, I mean 2025, that we are writing ICAN, these, these two names, these nomenclatures are no longer required. If you go and use them, you're on your own. It will impact negatively on your score. So the two tests that the auditor will conduct now to test whether the internal control system is effective or not is what we call test of controls and test of detailed transaction. Test of controls and test of detailed transactions, right? So what is test of control? As the name implies, these are tests that are put in place to confirm the what? The effectiveness and efficiency of what? Of the client's internal control system. Okay? These are tests, okay, that are put in place to do what? To check what? The efficiency and effectiveness of the client's internal control system. So once you carry out this test, right? Once you carry out this test, you really want to know what the result is so that you'll be able to know whether it's something you can what? It's something you can rely on, because if you're not able to rely on it, then it becomes an issue. That's what I'm saying. It becomes what? An issue. So that is the first test. The second test is called test of detailed transaction. What does this mean? This is a test, okay, that's conducted on what? To verify the accuracy and completeness of what? Individual transactions. This is a test that verifies what? The accuracy and completeness of what? Individual what? Transactions. So what that means is that the auditor selects samples, okay, of transactions from the company's record and verify whether they meet the following criteria. Okay, whether they meet what? The following criteria. For instance, they will check for what? Authorization. Who approved this transaction? So for instance, they want to pay 10,000 naira. Then the um the procurement officer was the one that approved it as against the general manager. So these are some of the controls the auditor will be checking. Okay. Accuracy. They wanted to post, they saw the invoice. Invoice is showing 55,000 naira. But they posted 5,000 naira. Or they posted 50,000 naira. That's accuracy. Completeness. The auditor is looking at the transactions, is looking at a particular procurement, and it saws that in a particular transaction, they're supposed to have invoice PO, away bill, and all those things. The only thing that is attached is just the what? The approval. The email approval is what is there. There was no PO, there was no invoice, there was no delivery note. Nothing is there. So those are the things. So once the auditor is able to test this and he passes, this test passes the auditor's test, then the auditor will do what? The auditor will continue to rely on the internal control. But where it does not pass this test, that is the test of control and test of the transaction, the auditor will need to tell them that he cannot rely on the internal control system. So that means that he's going to deploy another means, okay, to validating the transactions. That means they are going to, as a client, they are going to pay more because it's going to deploy more resources to putting things in order. All right. I hope we are together. Okay. So those are the things that the auditor will need to do after while he's trying to do what? Identify and select which approach will work. And what you also need to note here is that while determining the audit approach, there are certain things the auditor will need to also do. Okay. Now, some of the things the auditor will also need to look at is in an instance where it was the last auditor that audited the financial statement in the previous year, you need to check whether there has been some changes since the last time he visited. Okay. But before he determines that, he needs to look at the kind of business the client operates. What kind of business does he operate? That is one. That is, does he operate a computer-based system or a manually based system? Two, later we need to look at the level of what? Materiality. We're going to look at materiality in chapter 7, right? That is transactions they carry out. Okay? The author will need to look at the transactions they carry out and other things that we need to also assess. Then, if this is done, right, then the author will now proceed to checking whether there has been some changes in terms of what? Legislation since the last time. Now, last year, we're operating under a different regulation. That is tax law. All right? Tax laws. We're using a different tax law. This year, 2025, there has been a proposed tax reform. And once these reforms are passed by the National Assembly, they become what? Binding. That means that there's going to be changes in some of our tax laws. For instance, your payee now, once this tax law passes, the way we compute payee will change. Okay? It's what? It's what? It will change. Now, people that are before now, people that earn 30,000 naira and below, they don't pay tax. That's what we know before now. Minimum, they don't pay at all, right? Now, with the new tax law now, if it's passed, that means that if you earn below 1.2, you will not pay tax. So from 30,000, they have increased people that are not going to pay tax to what? 1.2 million naira. So you understand what I'm saying now? These are some of the things you need to factor in. Okay? Three, we are going to look at the information provided by management. Management has provided some information. Okay? And those information or that information that management provides need to be able to do what we call, what? An analytical review procedure on them. You need to be able to do what? Carry out what? Analytical review procedure. What do you mean by analytical review procedure? We're still going to talk more about this in chapter 8 under audit evidence. So analytical review procedures is talking about a process that shows related relationship or possible relationship between financial and non-financial data. We call it analytical review procedures. A process that shows what? Possible relationship between financial and non-financial data. So let me give you an instance of financial review procedures. So you have two comparative, the management accounts of 2023 and 2024. They ask you to carry out a comparative, they ask you to carry out an analytical review procedures on this. What are you going to do? You can look at you can use what we call ratios. You can compute ratios. Compute the gross margin ratio, compute the net margin ratio, compute the inventory turnover ratio, compute all of these asset test ratio, compute all of these ratios, and compare it between the previous year, 2023 and 2024. From there, you're able to know whether the company is making progress or not. Another thing you can also do is to carry out what we call net changes. Net changes, yes, is looking at what? The level of increase or decrease in the value of what? The comparative. For instance, you look at your receivables. 2023, your receivable was 100 million. 2024, your receivables is now 140 million. That means your receivable has increased by what? 40 million. Does that translate to a proportionate increase in your revenue? They're going to look at your revenue too. Revenue from last year, 2024 and 2023. If your revenue has increased significantly, then it could be a possibility why you're having what? Increase in what? Receivables, account receivables. But where your receivables has dropped, and when your revenue has dropped, and your receivable is increasing by 40%, that means that the cash cycle within your organization is in what? Is in negative. So you see that if you find yourself in that situation, you will see that you have what? Issues with what? Working capital. If you're struggling with what? Working capital. What's working capital? The money you use to run your day-to-day business. You want to buy raw materials, you don't have money, you struggle. You want to pay your utilities, you don't have money, you struggle. Do you understand what I'm saying? That's what we mean by analytical review procedures. Okay, you need to check it. Then you also need to look at what has changed within the law. Apart from the tax law I make instances of, for the business, have they changed? Have there been any changes? In 2023, they were doing things locally. They're just patronizing their local customers. But in 2024, they've started what? Exportation. And they started doing what? They have also developed new SKUs. What are SKUs? Newly developed products. SKU means stock keeping units. So new developed products. So and those newly developed products, some of them involves what? Importing some raw materials. So all of this, in a way, will affect the business, and it also enables the auditor to be able to determine what audit approach or which audit approach will be suitable for the client business. Another thing that you also need to look at, right, is to look at it has been changes in the accounting system. For instance, 2023, the client was using Sage 200. But in 2024, the client has migrated to Odo ERP, or they have migrated to Navision, Microsoft Dynamics. So all of this will impact the way the auditor will determine the approach to be utilized. The other thing that we also need to look at is what? If there has been a change in the deadline for submission of some of these reports. For instance, there could be some new reports that the regulators have introduced that they needed to do, or the company is trying to source for loans from the Bank of Industry, and that means that there are new requirements they need to fulfill. So the auditor should be on their toes to ensure that they meet with this requirement of their clients. Okay, they meet with the requirement of what? Of their clients. Then another thing that the auditor will need to also endeavor to do is to see that it uses what we call relational testing and what? Verification. What that means is that it's not all the time the auditor will be able to look sample, will be able to review every transaction. Imagine you have a client that is like a bank now, UBA or Union Bank, that has over 400 branches. And you say you want to review all the transactions. You are going to, 10 years from now, you are still working on it. So you are going to do what we call relational testing, or you do what we call random, all this sampling, or we do what we call um, risk-based audit, risk-based audit testing. All of these are what you are going to do. It's not possible for you to visit all the branches of your clients. I hope you know that. If you have some small clients, yes, you can visit all their, when they have just 2 offices or 2 branches, yes. When they have over 400 branches, it is impracticable to visit all the 400 branches within the one audit cycle. It's not possible. Okay? So those are the things that we inform the approach the auditor we adopt. I hope it's clear. Does anybody have any question before we proceed? Any question, comment, observation before we proceed? Are we good? Okay, thank you. So let's continue. Now, after the auditor has decided on the audit approach to utilize, they need to develop what we call audit planning memorandum. Audit planning memorandum. Either you call it audit planning memorandum or you call it audit strategy memorandum. We are practically saying the same thing. Either you call it audit planning memorandum or you call it audit strategy memorandum, you are practically saying the same thing. What is audit planning memorandum? This is a document that contains all the planning decisions of the auditor during the engagement. It's a document that contains all the planning decisions of the auditor during the what? Engagement. So all the decisions the auditor has taken as regard that particular engagement are what is contained in the audit planning memorandum. Some of the information that you have in the audit planning memorandum include what? The terms of engagement. The terms of engagement. So you need to ensure that even when you have a continuous engagement, you have to ensure that the audit engagement letter is reviewed annually, because there might have been increase in scope of the client business, which you have not factored in, or decrease in scope of the client business, which you have not factored in. So there is a need for you to review the engagement letter annually. Number two, and that is contained in that audit planning memorandum. Another thing that is also contained in the audit planning memorandum is audit risk area. The key risk areas of the business are also contained in audit planning memorandum. So the auditor will know how is going to push or allocate resources to this area, so that the client does not suffer any eventuality. So they are going to assign more competent audit staff to this area. And they are going to ensure that they evaluate the risk exposure. They carry out a risk assessment to be able to evaluate the risk exposure of the clients. Okay? So they're able to mitigate all areas. 3, in any planning memorandum, you're also going to talk about how the auditor intends to carry out its audit in the areas of what? Asset and what? Liability. How is going to validate or evaluate the company's asset and what? Liability. So it needs to be able to, the way is going to go about it needs to be contained in that audit planning memorandum. Another thing is also going to contain in the audit planning memorandum is what we call the presence of internal auditor. So if the client has an internal audit, the external auditor will detail that in the what? In the audit planning memorandum. That is, what information does it require from the internal auditor? For instance, the internal audit plan, the audit report, the competence of the auditor, the internal auditor, okay? And the level of efficiency. What do you mean by level of efficiency? He makes 10 recommendations in 1 year, 2024. Only one has been approved. That shows that internal auditor is not efficient. He makes 10 recommendations in 2024. 8 of them, or 7 of them, have been approved and implemented. That shows the internal auditor is what is efficient. So he's going to evaluate the work of the internal auditor in these areas. Okay. The other thing is also also be documented in that audit plan memorandum is whether it's going to make use of what? Specialists, or we call them experts in auditing. Whether it's going to make use of what? Specialists, or we call them what? Experts in audit. Who is an expert in audit? If I ask us now, an expert in audit, most of us, or some of us, will be giving me definition that you have in the dictionary. And but if you provide that in an exam, right, you'll have lost plenty mark, because experts in audit or specialists in audit is different from the definition of specialist or expert in the dictionary. So who is an expert? An expert, according to audit or in audit, is, according to ISA 620, is someone or organization that has competence in other field outside accounting and audit. Is someone or organization that has competence in other fields with S, other fields outside accounting and audit. Is an what? Is an expert. So what example of experts? Surveyors, architects, engineers, okay, estate valuers, risk management consultants, IT consultants, actuaries. All of these, they are what? They are experts in auditing. People that profess competence in other fields outside accounting and audit. Lawyers, they are also experts. All of these people, they are experts. So later we detail whether it's going to make use of them in the audit planning memorandum. Then the approach the auditor is going to use, is also going to state it there. That is it going to rely on internal control, or is going to use other strategy? Okay, so that approach is also documented in the audit planning memorandum. Then the timetable of how the engagement will go is also contained in the audit planning memorandum. How many months are they going to take? How many weeks are they going to take to complete that engagement? Is contained in the audit planning memorandum, and is followed to the letter. Also, another thing that is contained in that audit planning memorandum is the staff requirements, audit staff requirements. Why is he able to determine all of this? Because he has carried out what we call a preliminary audit risk assessment. So he knows how many staff that will be required. So the number of staff is going to be required to be detailed in the what? In the audit planning memorandum. The other thing is going to come, there's also going to be contained in the audit planning memorandum is the audit fee. How the auditor is able to determine his audit fee, how he's able to calculate it, okay? And the areas or the aspects where the audit fees covers. We also you the audit planning memorandum form part and parcel of the audit plan, as well as the audit working paper, which we are going to discuss in chapter 8. I take it again. The audit planning memorandum is part of the audit plan and is also part of what? The audit working paper. Okay? Audit documentation. I say, you understand? Audit documentation is also contained therein. I hope you understand what I'm saying. Now, any question before we proceed? Any comment? Any observation? Are we good? Okay, let's continue. I want to
Follow
look
it.
at everybody. Okay, thank you. So let's continue. Go to the next aspect of chapter 6, understanding the client business. You know, I made mention of this earlier that a specific auditing standard, that is ISA 315, categorically explains this in detail. That is assessing the risk of a business, of a client business. That you should be able to understand what the client is into because you cannot audit what you don't understand. That's what we are saying. So how do you gain understanding of the client business? One is by doing what? Paying personal visits to the client's premises or operating bases and only discussions with key officers. You need to visit the place. If you have not visited the place, you might not be able to know the extent of work you'll be doing there. And also whether the key officials are cooperative. Two, you also gain information by reading the minutes of meetings and correspondences with the client. So when they have meetings, departmental meetings, management meetings, other general meetings, the minutes of such meetings, you need to lay hands on them and do what? Read and understand. It give you an insight into what has happened within the business within the period under review. Another thing that also give you an insight to the organization is when you read the internal auditors report. The internal auditors report are divergent, right? Depending on the area that the audit is what is focused on. So by obtaining this internal auditors report, we give you more insight into what is obtainable in the client business. All right. The other thing that also give you an insight is by reviewing the audit working papers, or I call it audit documentation, ISA 230. Okay. If you pick up the audit documents or audit working paper for last year, 2024, and compare it with 2023, you are going to see a whole lot of what difference or information that you can utilize for 2025. Okay. Another thing that is also an area we can get information is by laying hands on the management report or the EIA, feasibility report. So that will give you an insight into the project the client business is into or they are about to embark upon the upcoming project. They give you an insight so you can ask questions. Okay. The other areas that can give you insight to the client business is by reading the what? The journals or materials that are relevant to the sector where the clients operate. Reading journals or materials relevant to the area of business where the client operates. Like the CBN now, as at the time I was in university, there's this material that the CBN produces called the Bullion, that's the title of that journal. And it just talks about the activities of that has taken place at CBN within the economy over a period of time. I'm not sure if it's still in existence. Okay. Then, let's say you have a client that's into real estate, there's this magazine or this journal, it's called the Casus, that give insight into the real estate world in terms of prices of some of those estate assets and the likes. Okay. If you have a client that is, let's say they are into law services, okay, they're rendering law services or all those things, right? For you to know how far they have gone, there is this weekly law report, okay, Nigerian weekly law report, African weekly law report, okay. Some of them before now, when I was in school also, The Nigerian Law Report was published by late legal luminary, that is Gani Faweyimi, is the publisher of the Nigerian Law Report. Okay, so some of these will give you insight into how the business operates, okay, or some of the services that they are into. So by the time you're able to review all these documents that I just explained, you have an holistic view of how the client business operates. Okay, so other things that will also be considered in determining the strategies to be adopted are: one, the auditor's responsibilities in terms of engagement. So what is the auditor's responsibility in terms of engagement? The primary purpose of the audit of the external auditor is to ensure that the financial statements are prepared in line with applicable financial regulatory framework. That is the primary purpose of the audit, to ensure that the financial statements are prepared in line with applicable financial regulatory framework. Then two, the nature of the client business. You need to know the nature of the client business. I don't need to talk more about it because it has already been what? Overemphasized. Then thirdly, the nature and significance of items in the year account. What does that mean? So you look at the financial statement, you look at key areas in the account. So what does that? How will you know that? So if you are somebody that have already understood the nature of the client business, you are going to know the key risk areas of the client business. Okay? So some of the key risk areas of the client business are inventory. You need to look at your inventory if you're into manufacturing. Inventory of raw materials, inventory of diesel, petrol, all of those things. You need to look at it. Another area you need to look at is your what? Is your cash and cash equivalent. You need to see whether they carry out cash count. Because if they don't carry out cash count, that means that somebody, the account officer or the accountant or the cashier, can take the balance, the remaining money in the company's coffers, in the company's safe at the end of the week, at the end of the month, on the largest, use it for weekend spree. And on Monday, or by the time they pay salary, you reimburse. Nobody will know. Okay? Then, another area that is important is also the receivables, revenue, staff cost. All of these are areas that are very important in the financial statement. Then lastly, you need to look at what the principal features of the client accounting system and the extent and effectiveness of the related internal accounting controls. So you need to be sure that your ERP or your accounting package is achieving its objective. You need to ensure that the accounting package or the ERP that is utilized in your client business is what? Is achieving is what? Its objective. It's very, very important. Okay? Any questions so far? Any comments? Any observation? Are
No,
we
sir.
good? All right, so you are getting it. Thank you very much. So the next thing we are going to look at now is to look at all these audit approach, the four of them. We're going to look at what? The four audit approach. So what we are going to do now because the time is fast spent, we are going to continue from there next week. But please read ahead because I will ask questions next week before we start. I will ask questions next week. So what are the audit approaches? There are four audit approaches. Okay? You have the substantive testing audit approach. You have the statement financial position audit approach. You have the system-based audit approach. And you have the business and risk-based audit approach. So these are the four audit approaches that we have. I take it again. Substantive testing audit approach, statement financial position audit approach, system-based audit approach, and business risk and risk-based audit approach. Okay? So all of these will be reviewed next week.